The credit crunch is here, whether you realize it or not, and credit tightening is occurring as people miss payments and as impaired loan surges. So let's get right into this. Canada's bank regulator moves to tighten credit as impaired loans surge. They don't really do a lot here, but we'll just go through it anyway. We've got so much to go through today, including, guys, one bank where it stands out compared to the other big five in terms of an anomaly with what's happened with some data. So anyway, we'll get into that at the end. Domestic stability buffer. The domestic stability buffer is money that banks have set aside for a rainy day. In the event a bank needs emergency cash, the regulator can authorize the use of the DSB, avoiding the need for the taxpayer bailout. Great. So why not raise it to 50% and have the taxpayers never hear the word bailout again? That's kind of being funny there. So the impact of higher DSBs can cost you a lot more. As a risk event approaches, the DSB rate rises, meaning banks are setting aside more cash. This reduces credit liquidity, which means borrowers will have to compete for what's left. Less credit liquidity results in more expensive credit, less credit, or harder qualifications. And that's exactly what we're seeing right now happen, whether or not they increase it 50% or not. We're already seeing that happen. So the credit tightening is occurring, and it must feel very, very like you're in a precarious place if you have a ton of credit and you're in a ton of debt, because this is not where you want to be. So very, very interesting. So let's go over to the Bank of Canada, take a look at M1 Plus and M1 Plus Plus and M2 Plus Plus. So let me describe these to you first so you understand what I'm actually talking about. M1 Plus, currency outside banks plus personal and non-personal checkable deposits held at chartered banks, plus all checkable deposits at trust and mortgage loan companies, credit unions, and Caisses Populaires, excluding deposits of these institutions plus continuity adjustments. So basically, this is a measure of credit, and I want to show you what's going on with it because it's kind of insane. And the M1 plus plus is the non-checkable deposit, so I'll read out that as well. M1 plus plus is gross plus non-checkable deposit notice deposits held at chartered banks plus non-checkable deposits at trust and mortgage loan companies, credit unions, and everything else. Less interbank non-checkable notice deposits plus continuity adjustments. So gosh, that was a mouthful. But you can see what's actually happening right now in terms of the growth rates is they are absolutely collapsing. M1 plus and M1 plus plus, they're absolutely collapsing. They've gone from a growth rate of around 30% down to nearly towards negative 10%. And April is the last data that we have. So we're looking in the past like everything on this. And you can see what's happened here. And even M2 plus plus, you can see that the growth of that has just absolutely, it's come way down. And, you know, if you expand this chart out all the way, going back to 1996, you can actually see that it was coming from a period, it looks like, during that recession in the 90s where it was below zero. But this is literally the only time, guys, the only time in like 28 years that we have seen this happen. And what that means essentially in layman terms is credit tightening. It means a credit crunch. And that's exactly what we're seeing in M2 in the money supply as well. So it's very, very interesting. If you want to go over this more, link is in the description. And let's think about why this might be happening. If you are a bank, the largest bank in Canada, the largest mortgage lender in Canada, and 1/5 of your borrowers are seeing loan balances grow, what does that mean for your risk? Your risk is absolutely skyrocketing, regardless of what investors think and regardless of what your stock is doing. The risk is skyrocketing because those people who are essentially in distress, you're extending them more credit. You're giving them more credit. And that is not a good thing because their ability to pay the loan was hindered anyway, and now you're making it worse, And you know, when I was describing this to Travis over at Real Estate Mindset and Orlando Miner, their mind was blown. And it was actually when Orlando said, hey, is this actually happening in Canada? I didn't even bring it up to him that we got into conversation about this. And I think I might get them on here to just show you how an outside perspective from the United States, how bad this actually looks, and how to them they're like, wow, 2008 much? Because that's exactly what it looks like. The predatory lending, the negative amortization that the US had in 2008. And why is this happening? This is happening because the people, the crux of it is, they cannot afford the homes. They can't afford to pay the mortgage payments. That is the crux of it. They'll default at a later date, but that is the crux of what's going on here. So kind of interesting. And then somebody sent me this and I thought, yeah, you know what? This kind of shows really how bad things are. But CBRE report says office vacancy rate in Q2 rose to the highest level since 1994. Again, what does this mean for the economy? You know, so it's kind of crazy. And then if you look at some of the office markets, like Calgary, for instance, it's kind of crazy because Calgary is at 31.5% vacancy rate. That is absolutely nuts. And they were saying it's down from 32%. Like, that's sort of, CBRE said Calgary has benefited from the expansion of the engineering, construction and education sectors. And it also notes that they're working to convert some of the office buildings, and they were only able to decrease it from 32 to 31.5. I mean, this is just insanity. It's like somebody, when the unemployment rates, it's literally like when the unemployment rate's at 32%, the mainstream media coming out and saying, oh, we got it down to 31.5%. Look at all the great work we're doing. A third of offices nearly empty in Calgary. It's absolutely crazy. And then you got the migration, that cyclical thing going on as well, which is always, you know, generally precedes a recession. So it's kind of interesting in that respect what's going on in Calgary, to be honest. And then I'll take you over to this, but credit card balances increase in first quarter as mortgage market shows, according to Equifax. So if I get into this, you'll see what I mean. The agency said in its latest consumer credit report that on average, consumers are spending 21.5% more each month on their credit card compared with pre-pandemic levels. This is unprecedented growth. I mean, that just shows you how people are coping with inflation. They're putting it on credit cards. It's literally probably the amount inflation has increased by or near enough that level over the past couple of years. So it's kind of nuts when you really think about it. But people don't see this. They just think everything's fine. And that's evident in the trends data that we went over on Monday. So missed payments on non-mortgage debts also rose, with 175,000 more consumers missing payments on at least one product, up 18.8% from a year earlier. So that is a massive increase. And yes, it might be at a low level still, but the trend is strong. That is a big increase. So, and are things getting better? Is the economy getting better? Are interest rates going down? No, the exact opposite has happened since then. So we're only just starting to see those lag effects. And this data is old data as usual, because when we get these TransUnion and Equifax reports, they're always ancient. We're talking about a couple of quarters ago. So it's kind of nuts, but it's the only data we have in Canada, unfortunately. And now I want to take you over, if you hung on to the end here, well done, because it's really interesting. You know, I was just going over the banks as usual, looking at their financials, looking for any anomalies to see if anything had changed. And I wanted to show you this because it is kind of interesting. This was the only bank that has seen a massive increase in short interest. And if you look, it's increased from 937 million to 1.61 billion. And that is an increase, guys, of 71.93%. So it's a big increase. And if you look at the chart as well, what I want to show you is if we actually go back to when we were in the banking crisis earlier this year, and the US was going through the banking crisis, and it was actually a liquidity crisis because you saw Credit Suisse fail, which was a systemic bank. So you can't just sit there and say, oh, this was isolated to just the US. It was just the US. And you also saw global bond yields collapsing when that happened. So, you know, everybody was going to those safe assets, whether you think they're safe or not, government bonds, but that's what they were going. There was this flight to safety, sorry. So it's really interesting that you've seen a massive increase, similar to the increases that we saw during the last or right before the banking crisis. And what's really interesting is we're going into another liquidity bottleneck. Typically, the liquidity bottleneck that we get is around September, October, November time. And you even saw this last year with short interest actually rising during this time. So big money is betting against bad things happening, essentially. So it's kind of interesting. And if you look going back to 2021, look how low the short interest was. And, you know, we don't have any more data than this, unfortunately, but you can see that I'm sure I could get data, and I'll have to look for some actually, but you can see how this has increased massively. And over 2022, obviously we saw with the trends data on Monday, in Monday's video, that essentially the trends data was showing that in 2022, there was real fear of recession. People were searching for it. They were Googling it. So that was happening. But now, if you look at it, you're just seeing a massive increase, but it's not the same for the other banks. So why the Bank of Nova Scotia? That's the question that we've got to ask. Why is the Bank of Nova Scotia seeing this massive short interest? And the Bank of Nova Scotia is very involved in emerging markets, and it's also very involved in China, along with BMO. In fact, those banks are very risky when it comes to China and what's gone on there, because nobody really knows what they've been doing there. It's hard to say. So they could get burned massively there, because what's going on in China is still happening. The real estate collapse is still happening in China. So that's still going on. So you have to bear that in mind. And then you've got CIBC, which is also the biggest mortgage lender, currently being audited by the OSFI. And those people, and they're the biggest mortgage lender. So these three banks, they are the ones to watch, in my opinion. I'm watching all of them to see if there's just any strange anomalies in the data. And that is what we're seeing with the Bank of Nova Scotia. But as you can see in the past, it's pretty normal compared to 2022, but compared to 2021, absolutely not. So there's definitely something going on, possibly, maybe, we'll have to wait and see. But coming into this next liquidity bottleneck in the fall and winter, who knows what's going to happen? Have things got better or worse? They've got worse. So anyway, guys, if you've enjoyed this video, you might like this video here. You might also like this playlist here. I will see you on the next one, guys. Take care of yourselves. Bye-bye.